Hey everybody, welcome back to another edition of 5 Question Friday, where I do my best to answer questions you all have sent in. Got 5 great topics for you today. Let's take a quick look at them. First, we're going to talk about asset location. A viewer is investing in a fund that pays dividends, wants to know should they put that in a Roth or a taxable account. Number two, a viewer has a question about S&P 500 funds, two different funds with two very different share prices, and they're trying to understand why that would be. Question 3 is going to deal with the difference between stock buybacks and dividends. Question 4, when you're thinking about your net worth, should you subtract the taxes you'll eventually owe on retirement accounts when you take the money out? And then finally, are we bankrupt? Did the Treasury Department really just announce that the United States is now insolvent? We're going to look at that question, and we're going to look at it from a very unique perspective, I think. I'm looking forward to that one. By the way, I will include timestamps below the video, so you can jump around to whatever questions interest you. All right. If you want to send in a question, subscribe to the newsletter with the link below this video. It's free, goes out every Sunday, and then you can just hit reply to any email you receive from me. Would love to hear from you. All right, so let's dive in. First question comes from a viewer named Karen. Here's what she says. She said, if I buy SCHD, and we'll look at that fund in a minute, should I put it in my brokerage account because of lower capital gains rates, or in my Roth where dividends would never get taxed? It's a great question. Let's take a look at that fund. Here we go. So I've just looked it up in Morningstar. And by the way, if you're not familiar with Morningstar, you can just go to this search bar here and type in any ticker, and you can see it'll automatically pull up. In this case, it's the Schwab US Dividend Equity Fund. We're already there. Full disclosure, I own shares of this fund. And by the way, I own them in my Roth account. All right. So Karen raises some really important questions. I think this is important whenever you're going to invest in a fund and you want to think, what account is it going to be in? So here's the deal. As you can tell from the name of this fund, it pays a fair amount in dividends. Certainly it pays a higher dividend yield than, say, just a total U.S. stock fund or even an S&P 500 fund. And we can see that here in Morningstar. You got to hit this little button for it to scroll over. And you can see the SEC yield here is 3.41%. Now, you also see a trailing 12-month yield. That's what TTM stands for, trailing 12 months, meaning just the past 12 months. The reason it's different is the SEC yield looks at the dividends that were paid in the last 30 days and then calculates what the annual yield would be if that same amount of money was paid out, every month for a year. And so the SEC yield kind of reflects a more current circumstances. And it's the one I tend to focus on, but as you can see, they're not dramatically different here. But when you think about an S&P 500 kind of fund, you're probably looking at a yield just over 1%. So it's pretty significant. It's a significant jump from just a total market kind of fund. And so the question you have to ask is, if you put this in a taxable account, you're going to get taxed on that. And you have to understand what the tax consequences are for you now. And it could be different, right? Because depending on your other income, you may get taxed at the highest levels, and we'll talk about that in a minute, but or maybe pay no tax at all if you're at the lower end. So, there's no one answer here. You've got to sort of evaluate this, based on your personal set of circumstances. But the one thing I want to point out is that when a dividend gets paid from a fund, one of the things we want to know is it a qualified dividend? You have qualified dividends and non-qualified dividends. Qualified dividends, there's a couple of requirements they have to meet. Typically, there's some exceptions, but from U.S. companies, and there's certain holding periods that have to be met. But the point is, if it's qualified, then it gets taxes effectively like long-term capital gains. And if it's non-qualified, you get a lot of that, for example, in international funds. It's taxed as ordinary income. And so to Karen's question, we want to know, well, okay, Schwab U.S. Dividend Equity ETF, are you qualified dividends or non-qualified dividends? Well, believe it or not, that can change from year to year. And if we jump to this article, this is for 2025, we can actually, I think SCHD is near the top. I saw it before. Here it is. It's right here. Probably kind of hard to see. Let me see if I can make it a little bigger. SCHD, and you can see this column here is QDI, Qualified Dividend Income. I think that's what that stands for. But in any event, it's almost, not quite 100%. Whoops, here it is. Not quite 100%, but almost. It's almost all qualified, 98.48%. I think last year was 2024. I want to say it was 100%, but obviously a very high percentage. And so if this is in a taxable account, then you're going to get most of it will be taxed as qualified dividends. And then of course now it's up to you to figure out for your circumstances. You could be at a 0% rate, or you could be at a 20% plus 3.8% for the net investment income tax plus whatever your state charges. So you have to evaluate that. But that's how I would think through this question. Now, the other thing you want to consider is that we think about capital gains distributions. If we go to sell shares of a fund, we have to recognize if there's gains, we have to recognize those and they get taxed. But for funds, mutual funds and ETFs, they can sometimes distribute capital gains even if you haven't sold any shares. So you want to make sure the fund is not doing that, or at least if it is, that you include that in your evaluation of the tax consequences. So how do we do that? Well, one way is just to go back over here to Morningstar. We're going to go to performance right here. And then we want to go to distributions. And at least for the last 5 years, we can see that everything this fund has distributed is green. What's green mean? Green means income. In this case, since it's a stock fund, it would be dividends. If it had distributed short or long-term capital gains, we can see from the items here, light blue and dark blue, you'd see a bunch of blue here. Well, they haven't done that. And typically that's fund, I don't know if it's ever distributed capital gains, short-term or long-term, but since I've owned it, it has not. And so good, that's good, because that could generate additional taxes if you choose to hold this in a taxable account. Now, what would that look like? Can we think of a fund that actually does distribute capital gains? Sure. How about ARC? Here we go. This is one of the Cathie Wood funds. And if we go to performance and go to distributions, you see all kinds of blue. So this is a fund that distributes a lot of capital gains. And you notice it distributes very little in the way of dividends. And I think that's simply because she invests in companies, growth companies that don't typically pay a dividend for the most part. So the point is here, though, this doesn't necessarily mean it wouldn't work in a taxable account. I suppose depending on your specific tax circumstances, maybe it wouldn't be a big tax hit if you don't have much other income. I know for me, I wouldn't own ARC to begin with for a lot of other reasons, but I certainly would never own a fund like this in a taxable account, or for that matter, SCHD. For me, it would just generate additional income that gets taxed that in my situation just wouldn't be good. And so that's why we hold it in a Roth. But again, taxes are very personal and specific circumstances. For some of you, holding SCHD in a taxable account may be a reasonable choice. But that's how I would think through the questions. And yeah, great question, Karen. Appreciate it. All right. Question number 2. This comes from a viewer named Rob. Love the name. I was wondering how mutual fund share prices are determined. For example, I own FXAIX, we'll look at that in a minute, in my IRA, and VFIAX in my brokerage account. Both are based on the S&P 500. Yet as of Friday, FXAIX was $230.91, while VFIAX was $613.72. What's going on? Well, let me first show you the funds. I don't even know which way to look. I've got so many computers I'm staring at. Here we go. So this is the Fidelity fund, ticker FXAIX. It's an S&P 500 index fund, very low expense ratios. We love it, right? And this is the Vanguard 500 index fund. This is, again, the mutual fund version. Actually, a little more expensive than Fidelity, but still very, very cheap. Here's the deal, and this is true, by the way, with stocks, not just mutual funds or even ETFs. You can't draw really any conclusions from the price, right? Because part of the question is how many shares outstanding, in this case, mutual fund, does a mutual fund have? For a mutual fund, they're always calculating what's called net asset value. You just take all of the assets. In this case, it's primarily stocks, right, in the S&P 500, but they're going to hold some cash too. There could be some liabilities. You'd subtract those if there are any. And then you divide by the number of outstanding shares, and that gets you your net asset value. And mutual funds always trade at net asset value. Remember, you can put an order in to buy or sell a mutual fund during the trading day, but it's not going to actually get filled until after the market closes. And in this case, Fidelity or Vanguard can figure out all of the closing prices of all of the stocks it owns in this case and come up with a net asset value, and then it'll execute the trade at that net asset value. But yeah, it could be very different comparing Fidelity and Vanguard, but it really has no effect on which fund you would invest in, or if you think about if we look at this one that's $610, let's imagine you invested $610. This is the NAV as of I guess it would have been as of yesterday, March 25th. You'd own one share, okay? But if you said, well, if I invest in Fidelity, I could get not quite, but almost 3 shares, sure. But in both cases, you'd have $610 worth of the S&P 500. It's like it's like trying to cut a pie into more pieces. It's still the same size pie. So yeah, you really can't draw any conclusions from the price itself, and it will vary. In this case, really dramatically, even though they both cover the S&P 500. Great question. All right, moving right along. Question number 3. This also comes from a viewer named Karen. I've been considering buying a dividend fund or ETF. And by the way, I think this is the same Karen from question 1, related, but a very different question. An article I read recently has me questioning that idea. Do stock buybacks or dividend payouts matter when considering what to buy? Well, that's a great question. So here's my take on it. If you were going to invest in an individual stock, not a fund, an individual stock, you're going to buy Apple or Microsoft or whatever company was of interest to you, their dividend policy and their buyback policy are critical factors to consider. As if we step even further, just more broadly, what you want to know is, what's this company doing with all of its profits? Does it have the shareholder in mind? Is it doing smart things with the profits that it earns? And that could include many things: reinvesting back into the business. It could include potentially buying other businesses or assets. It could include paying a dividend or buying back stock. And it often includes all of those things. But you want to make sure, as best as you can, that the management of this company is doing smart things with their capital. Now, all other things being equal, and by the way, they're never equal, I personally really like the idea of buybacks, because at least for me, they don't have any tax consequences. There are actually now some federal taxes that can affect at the corporate level for buybacks, but it's not a taxable event. When a company pays a dividend to me, even if I don't want it, I've got to take it. Right? I'm not going to call up Apple and say, "Don't send me your dividend." It doesn't work that way. And so I get that dividend in whatever amount management decides, whenever management decides to pay it, and it's taxable for me. On the other hand, a buyback is not taxable for me. And the net effect, if we exclude taxes, is pretty much the same thing from an investor perspective. And a lot of you are going to say, wait, Rob, there's all kinds of differences. Well, if we think about it this way, when they buy back shares, that just reduces the number of shares that are outstanding. And what's the effect of that? All other things being equal, well, it increases the value of the remaining shares, including any shares that I might own. Well, with the dividend, it's actually kind of the opposite. It actually lowers the value of each outstanding share, because the company has just distributed what can be millions or even billions of dollars out to shareholders. And when the company writes those big checks, its net worth goes down. And so the value of the company goes down, and that absolutely gets reflected in the share price. But I have this cash to make up for it. Either way, I've basically got the same value, except that dividends are taxable. All right. Now, that doesn't mean dividends are bad or the company shouldn't pay dividends. It's just very different than buybacks. At the same time, I don't want a company buying back their own shares if the price is sky high and just a ridiculous price and the company's overvalued. I don't want the company spending its money buying back shares at a ridiculous price. So depending on the circumstances, one might be preferable to the other. But that's when you're analyzing an individual company. When it comes to funds, ETFs, frankly, I certainly look at the dividend yield to understand the kind of fund it is. And again, taxes and where I might want to hold that fund, but I don't really dig into the details to look at all of the companies it owns and what's the buyback policy for all of those companies. I suppose you could. I've never done it. I don't know that it would change the kind of funds that I buy. It's one of the nice things about just investing in index funds. You don't have to worry about all of those details that might be very important if you're picking individual stocks. So, Karen, that's my take on the question, and love the question. All right, number 4. This comes from Bill. When calculating net worth, should the taxable portion of tax-deferred accounts be excluded? So in other words, let's just imagine you've got $100,000 in an IRA, and you know that when you pull it out, we'll just make up a number, $30,000 is going to have to go to Uncle Sam and maybe state income tax, I guess even possibly local income tax, depending on where you live. So should you put that in your net worth statement as $100,000, or should you sort of back out the $30,000 that you'll eventually pay in taxes someday and list that as $70,000? So it's a great question, and here's my take on it. I don't back the taxes out. If I had $100,000 in an IRA and my net worth statement, I would report it as $100,000. Now, why is that? Part of it is that I try to watch out for what I call mental accounting, and this becomes a big issue with taxes and retirement accounts, because we know that when we distribute money out of an IRA, it's going to trigger taxes. And so we tend to attach those taxes to that IRA and kind of look at them together. And I get that makes sense. But the reality is taxes are just one of many expenses. There's other expenses that are going to come out of that IRA, like sales tax. Should I try to calculate that and subtract it out of my net worth? What about real estate taxes? Or I don't know, buying a gallon of milk. Now, we could say, well, that's different. Yeah, it is and it's not. At the end of the day, we're going to have a lot of expenses that get paid from that IRA. I know we often look at our budget on an after-tax basis, and that makes sense when you get a paycheck. And if you do that for your net worth statement, I'm not at all suggesting that's a bad way to look at it. But my question is, what decisions are we actually going to make based on that data? In my case, I track our net worth mainly as kind of a scorecard, just so I can just see our progress or maybe lack thereof, just so I know how it's changing from year to year. Because to me, it's sort of the ultimate financial scorecard, more important than your income. Obviously, expenses are important. Those are important things. But at the end of the day, your net worth statement shows, what you've been able to save over a lifetime, right? It's a lifetime scorecard. And I like to just track our progress. I don't feel a need to subtract out the tax liability, or for that matter, any other liabilities that I might have to pay out of that money. But again, there's certainly no harm in doing that if you like to just see that number. Now, I want to stress the taxes that you're going to pay out of that are important, and it's important that we plan for that. But that's why I use tools like Bolden or Projection Lab. These are retirement planning tools, and they calculate the taxes for you for every year through retirement. So I use retirement planning tools to sort of bake in the effects of the taxes that my wife and I are going to have to pay when we start pulling money out of our 401k, whether it's through RMDs or just to pull the money out even before then to spend and to live on. I let the retirement planning tools do that for me. That's how I handle it. Again, no right or wrong here. And if you want to track the taxes you think you'll pay, that's certainly fine. And in fact, I can show you one tool briefly. Here it is. Kubera is an affiliate. I earn a fee if you sign up for Kubera. They are not a sponsor, however, of the channel or this video. But in any event, this is a tool I use to track our investments. And you can see right here, tax estimate. I've got the numbers blurred out, but tax estimate. It actually generates an estimate of the taxes that we'll pay when we start pulling money out, not only from retirement accounts, but what about taxable accounts that have unrealized gains, right? You can do the same thing there. But I'll be honest with you, I don't really pay much attention to that number. I don't know. Maybe I should. What do you think? Let me know. Okay. Fifth and final question, kind of the one I've been waiting for because this is fascinating. And here's the deal. I got several questions from folks about this article. Let me show it to you. Here it is. And it was published on Fortune. The Treasury just declared the U.S. insolvent. The media missed it. Oh my, that's scary. Yeah, that's clickbait. It's absolute clickbait, but there's kind of some truth behind it. And I want to show you why, but I want to use a tool to do it. And I'll be honest, it's kind of selfish because I'm actually killing two birds with one stone, because I had several questions that asked about that article, which I'm going to answer. And then I had another question seemingly completely unrelated from a viewer named Dan. Here's what he said. Is there a person or program you'd recommend out there for a tutorial in making the best use of AI? I am a journalist and author, now drowning in years of material, a lot of it interviews, pretty technical government reports, etc., that could sink a boat. We're going to look at some of those in just a second. Your use of it to help organize all your YouTube broadcasts is my inspiration. So I'm going to show you a tool that I use. I'm actually using it to write my book on retirement because I'm downloading tons of academic research. Some of them can be 20, 50, 80 pages long. And how can we use AI to do it? And I'm going to show you a tool that I use, and we're going to use it to answer the question about whether the U.S. government is insolvent or not. Here we go. So I'll show you this in just a second. Here it is. So this is the tool that I use a lot. This is called Notebook LM. It's actually a tool that Google came out with. And you can create notebooks, and you can then upload PDFs, YouTube videos, websites, whatever you want. It's really quite good. And I created a little notebook, and I'll show it to you in a second. But I only included two things in it. I'm going to show you what I included. Let's see. I included this report. This is the 2025 report, pretty sure. Yes, that was the basis for that article we looked at a second ago. You might not be able to read this up here. I don't know. It's 245 pages long. Who wants to read that? I also got the same report from 2024, and I put them both in Notebook LM in this notebook right here. You can see them over here. They're just PDFs. The way you upload them, by the way, is you can add a source. And then in this case, I just uploaded files because I had downloaded them to my hard drive. But you can do websites. You can, if you have things in Google Drive, of course, you can upload URLs, websites, whatever you want, pretty much. And the first thing I started to do, I did a lot of this ahead of time just to speed things along. But this is like a chat. You can now, not unlike ChatGPT or Gemini, except that it's answering the questions based on the documents you've actually uploaded. Is the U.S. insolvent? And basically, what they say is, well, yeah, not really. And they come down here, and the thing that I like, does the 2025 report indicate that the United States is insolvent? It does not state that the United States is insolvent, but it strongly emphasizes that the government is currently on an unsustainable fiscal path, and it goes on. But here's the thing that I like about it. You'll notice these little numbers here, right? You can, if you hover over them, what it does is it shows you where in these lengthy documents it's pulling this information from, right? And so you can get additional information. And here, let me just see where it goes if I pull this up. Yeah, this just goes to the front page. But this is showing total liabilities of 47 trillion and total assets of 6.1. That is actually correct. And in fact, I found that on my own. We'll go back to the document for just a second. And it's on page 65. They actually have financial statements here. Here it is. Here's the balance sheet. And you can see 2025, these are total assets and total liabilities. Not pretty, right? But you can then drill down into this and start asking additional questions. And so here, I want to focus on this. It says, however, the report provides an important caveat regarding this imbalance, those assets and liabilities. The government's formal balance sheet does not include the financial value of its sovereign powers, specifically its power to tax, regulate commerce, and set monetary policy. And in fact, if we come over here, it's just easier to see it in this version. It's in there right here. Sure enough, Notebook LM found the exact place where this information is presented. The other thing I would point out is that, and I was asking different questions, I won't go through them all, but this is nothing new. It's not as if something happened in 2025, as, in my view, this article suggests, at least the headline suggests. Yeah, that's not what happened at all. I mean, we've been kind of in a tough spot for quite a long time. Now, the reason I wanted to show you Notebook LM, though, you say, well, that's okay, Rob, but I could have probably just done that with regular old Gemini or Chat GPT. True, but you have a lot of options over here where you can produce a lot of different ways to look at all this data. And I just want to share a couple of these with you. And the first one is you can actually create a podcast, so to speak, where AI, two characters, I'll call them, talk about the data that you have. And you can actually ask specific questions, which I did. And I want you to just listen to it. I'm going to turn the volume up. Hopefully you can hear this okay. Let's give it a start. Let's give it a try.
What would you do if the interest on your credit card suddenly cost more than your rent, your groceries, and your car payment combined?
I mean, I'd probably have a panic attack.
Right.
It's very natural sounding, and the information is excellent. It's a wonderful tool in that regard. But we can look at a couple of others that I'll show you briefly. You can create infographics. I love this infographic. What's interesting? Yeah, here we go. That looks depressing. You can see this poor guy's carrying about a $48 trillion rock. Not good. But it created this data from that 245 page PDF. You can do this is a slide deck. Make it a little bigger for you. The one thing I'll point out right here, and this is accurate, social insurance gap expanded by 10 trillion. I don't know why. I didn't read the details of the report. I could certainly ask Notebook LM, and so could you. But it put together a really good slide deck. And of course, it didn't just decide what to put in there. I specifically asked it questions to generate that slide deck. And I point that out because you could then keep going back with more questions and getting new slide decks. And it actually created a video, which I haven't watched yet. If I can, I will make this little notebook that I created public. I think I can. If I can, I'll leave a link below the video. And if I can't, well, I'm sorry, I tried. But Notebook LM is a great tool. And in terms of our country's finances, yeah, they are a mess. They were a mess last year and the year before that, and they are getting worse. But there was nothing specifically that happened that made us insolvent this year. But last year, we were perfectly fine and not insolvent. And it's probably not the right way to think about our country's finances in terms of being insolvent. But yes, when you look at the financial statements in that 265-page document, I think, it does show a lot more liabilities than assets, and I'll link to that as well below the video in case, I don't know, you want to read a 265-page PDF. Well, there you go. My best answers to the great questions that you all have sent in. If you have any questions, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.